In today's talk, I'm going to go over some of the main concepts in my book, The Bitcoin Standard. And the first, I'm going to begin with explaining, what is Bitcoin, the definition that I came up with for Bitcoin, and then Bitcoin's monetary uniqueness. What is it about Bitcoin that makes it so unique? What is Bitcoin good for? And what are some of the implications of the use of Bitcoin? So my definition of Bitcoin is that Bitcoin is a peer-to-peer software for operating a payment network with its own native currency that is protected from unexpected inflation without having to rely on any trusted third parties. I think this really captures the essence of what we have here. It's a form of software that is peer-to-peer and that it's distributed over the internet, and anybody can download it and use it, and any member of the network is a peer with other members, so it's perfectly voluntary. And what that software does is that it operates a payment network between participants on the network, and that payment network runs with its own native currency, which is digital, and whose supply is protected from unexpected inflation. There's no way for anybody to make more of that money, which I think is the most important economic property of Bitcoin. And all of that is done without having to rely on any single trusted third party. There aren't intermediaries that you need to rely on in the transactions that take place on the Bitcoin network. The significance of Bitcoin, in my mind, lies in two main properties. The first one is that it is the hardest money that we have ever discovered or invented. And I'm going to discuss this in a little bit more detail now. And second is that it is the only working alternative to central banks for international payment settlement. So first of all, when we think about the hardness, if you think about it, anything can be used as money. There's no reason why anything can't be used as money. Anybody who decides to hold something, not for the sake of consuming it, but for the sake of exchanging it for something else later on, is choosing to hold that thing as a form of money. And so, but anything that gets held as a form of money, the value of it rises. And because the value rises, that gives people an incentive to make more of it. So anything that is easy to make ends up being a lousy money because people can make more of it and the value of it will drop. And so if you look historically, you find that the things that have been used as money historically are usually things that are hard to make. And in fact, you find that whatever is used as money is whatever is the hardest to make at any particular point in time. And so there are these examples which I discuss in more detail in my book. But if you look at the beginning of the 19th century, at the beginning of the 20th century, you see that the entire world effectively was on a gold standard, or the vast majority of the world was on a gold standard, because at that time, gold was the hardest money that we had ever had. And for a very long time, we know that gold supply is only increasing at around 1 or 2%. This has been the case for about a century. We look at global gold production, we see that every year it goes up at around 1.5%. And that is, in my mind, what makes gold the most likely monetary asset, the most popular monetary asset in the market all over the world at the beginning of the 20th century, because it is the hardest money. And even, the supply continues to grow at a very low rate. So there's no way for anybody to make increasingly large quantities of gold and to bring them onto the market. Now, why is this important? Because if you look today, you see that Bitcoin is basically the hardest money ever. Bitcoin's supply grows but flattens out. It stops growing at around 21 million Bitcoin. There will only ever be 21 million Bitcoin. And that's it. There'll never be more. And so the supply growth rate starts off high, but then begins to drop as the already existing supply increases and the new supply becomes less and less significant. So the current annual growth rate is around 2 to 3% for Bitcoin. And over the next 2-3 years, it's going to be a little less than 2%. And then in 2025, it'll drop again to under 1%. And then it'll continue to drop under 1% until effectively it reaches zero in sometime in the next century. So this is quite unique. And this, I think, makes Bitcoin quite interesting as a monetary technology, because it is the first money that we have whose supply is completely irresistant to irresponsive to demand. In other words, With everything else, if something gets chosen as money, more people will be trying to produce more of it, and so the supply will increase. But with Bitcoin, there's no way of producing more of it because of something called the difficulty adjustment. When you try and make more Bitcoin, you don't make more Bitcoin, you just end up expending more processing power and electricity on making Bitcoin more secure. And so the way that I like to present this is, if you look at it, with every other form of money that we've ever known, if people use it as a store of value, the price will rise, there will be more profit to be made from mining it, and that leads to an increase in the supply, which then leads to a drop in the price. But with Bitcoin, on the other hand, this cycle, this process is a cycle. And the reason for that is that we have the three steps. The store of value demand increases, it causes the price to rise, it causes mining to become more profitable. But in the case of Bitcoin, if you start mining more Bitcoin, you're not able to increase the supply. There's no way of increasing the supply of Bitcoin. So instead, what ends up happening is that more hashing power goes to mining. So more people are spending more resources on mining, and mining becomes harder, and the supply of coins stays the same. That's how the difficulty adjustment works. Instead of the reward for mining rising, the reward stays the same, but mining becomes harder. And so no matter how many people are using Bitcoin and how many people are trying to mine Bitcoin, we're only going to get a certain number of Bitcoin produced every day. Around these days, it's around 900 coins. And for the next 3.5 years, it's going to be 900 coins a day, regardless of how many people are trying to mine Bitcoin. The 900 coins a day is a set reward, and the difficulty of mining adjusts in order to make sure that we continue to average around 900 coins a day. And that's how this has been working. So in other words, when mining becomes more profitable, more hashing power is going toward mining, but the supply does not increase. Instead, more hashing power is effectively protecting the network. So the network becomes harder to attack. It becomes more expensive to attack the Bitcoin network. It becomes more expensive to make the Bitcoin network unusable. And that gives Bitcoin the ability to survive longer, which makes it more attractive as a store of value, which attracts more store of value demand. And this, in my mind, is the only way that we can explain and understand the incredible rise in the price of Bitcoin that we've seen over the last 10 years. Bitcoin has basically gone up, 11 years now. Bitcoin has gone up about 1.5 to 2 billion% in 11 years. And nothing has ever gone up like that, ever. And I think this is really the only way to understand it, is because Bitcoin's supply is completely irresponsive to demand. With anything else, if there's more supply, if there's more demand, we can always make more. We're always able to make more of anything else. But with Bitcoin, there's a strict fixed limit on how much we can make from it, because of this thing that we call difficulty adjustment. So the difficulty adjustment really is the most amazing technology in Bitcoin, in my mind. It's the magic sauce that makes Bitcoin work, because it protects the network from inflation, and it ensures the supply is auditable and verifiable by all network members. And it converts people's inevitable incentive to increase Bitcoin supply into network security. So it makes the network more secure, and it does that by using the incentive of people to increase the supply of the currency. So it's the reason why I like to call Bitcoin an all-conquering juggernaut of economic incentives. Whereas everybody competes to inflate all other monies, whereas everybody's competing to increase the supply of every other currency that is out there, people compete to secure Bitcoin, not to inflate it. So people compete to make Bitcoin more secure, which ends up making it more attractive. So Bitcoin really solved the inflation problem in the most neat way imaginable, because instead of providing people with an incentive to increase the supply, it provides them with an incentive to make the network more secure. And how secure is Bitcoin? Well, Bitcoin it has no single point of failure. It has no single piece of critical hardware or infrastructure, no single critical individual or organization. It basically can't be stopped. It's a protocol that is always open to anyone who wants it at any point in time. Around every 10 minutes, a new block of transactions is released. And this has basically never failed in the 10, 11 years that it's been going on. And it's never confirmed a fraudulent transaction. So far, nobody has managed to spend money they don't have on the Bitcoin network. So the hardest money that has ever been invented is basically available worldwide for anyone who can receive 2 megabytes of data every 10 minutes. You don't even need a computer or an internet connection. There are ways to get around that to use Bitcoin. It's purely voluntary. It does not need regulation, enforcement, or the police. And it's chosen and valued freely on the market. It's sound money. It's money that gets its value because the market gives it value, not because anybody forces its value. So what is Bitcoin good for then? Well, for me, I think the most important use case of Bitcoin is that it is a store of value. And it's an obvious use case because it's the first strictly scarce liquid asset that we've ever had. And in fact, if you think about it, one of my favorite books is a book called The Ultimate Resource, written by economist Julian Simon. And in this book, Julian Simon explains that the ultimate resource in the world really is human time, because with human time, we're able to make more of any other resource. The limit on how much we have of oil or silver or gold or copper or nickel or zinc, the limit on how much we have of all of these metals is simply how much time we dedicate toward mining and producing them. The amount of them that exists in the crust of the earth is far beyond our capability to process and consume. And the limiting factor really is just the time that we are able to dedicate to producing those goods versus other goods. We could always make more of anything. And that's why, we never run out of these metals. No matter how much we find, no matter how much we consume, we keep digging in, we keep finding more. Because, the limit is not how much exists on Earth, because that's so far larger than we can even ever imagine or calculate. The Earth is enormous. The limit is how much time we have for other things. The limit is that the limit is the opportunity cost in terms of our time, in terms of other things. And so before Bitcoin, anything that we chose as a store of value in this world had the imperfection that its supply will increase in response to it being chosen as money. But Bitcoin doesn't have that. So naturally, it ends up working out really well as a store of value. And so ultimately, the only thing that is scarce is time, and Bitcoin is the second thing that is truly scarce. And so for me, that's a natural match between the two. If you want to store the value of your time in a money, you would want to store it in a money that is scarce, like your time. So this is why I like to call Bitcoin the most advanced technology for transferring the value of time into the future. The second thing that Bitcoin, I think, is good for is that it is the decentralized free market alternative to central banking. Until the year 2009, if you wanted to send money from one country to the other, the only way that you could do it was you had to go through financial institutions that are operated by central banks. And so central banks have a national monopoly on this process in every country. And they're able to monopolize the market for sending money in and out of the country, and it's had terrible consequences in many places for many people, and in many of those places and in many of those times, people didn't have an alternative, because where do you go? How do you trade with people outside your country? If you can't have a bank, you can't send physical gold in reliable ways that are cheap and economical. There was no alternative. So you have to have your savings always with the local banking system, which was also lending to the government and likely to witness significant devaluation. Bitcoin offers us the first alternative to that. It really is the first working alternative to international payment settlement. It's digital, and yet it does not require the supervision and the control of national central banks. And one important aspect that I get into in detail in my book is the issue of how Bitcoin grows and how Bitcoin scales. There is, I think, a common misconception that Bitcoin is a payment network, that you can think of Bitcoin and compare it to PayPal. But in my mind, I try and explain the idea that Bitcoin is actually is better understood as being a settlement network. It's a network for a small number of high-value transactions. And this is the way in which the network has been evolving over the past few years. It's growing in this direction where the number of transactions conducted on Bitcoin every day has been roughly constant for maybe 5-6 years now at around 300 to 500,000 transactions a day. But the value that is transacted continues to increase significantly. More and more money is being sent on, more and more value is being sent on the Bitcoin network, even though the number of transactions is the same. So in that sense, Bitcoin is growing as a settlement network, and I think in this regard, we're going to see it grow more in this in this capacity. And I think you see more and more of the businesses that are being built around Bitcoin at this point are focusing on this kind of use case. And an important part of this is the fact that it's we see it with corporations now looking into Bitcoin, into using Bitcoin as a cash settlement. Sorry, as a part of their cash reserve assets, rather than thinking of using Bitcoin for payments. So a few years ago, a lot of people used to think that, when is Starbucks going to adopt Bitcoin? When is McDonald's going to adopt Bitcoin? In their mind, the idea was there, you would be able to pay for your coffee or your burger with Bitcoin. But I think what we're seeing is that we're going to be witnessing Bitcoin transactions being performed, Bitcoin coming into those companies from the balance sheet, not from the, they're going to hold it as cash rather than accept it for small payments. And I think eventually we'll see small payments being built on Bitcoin eventually. But for now, I think that the compelling use case is to hold it and use it for large amounts of settlement rather than for daily small transactions. So this is why in my book, I analogize Bitcoin to gold, because similarly, with gold, the trade was happening with a gold certificate. So we'll see second layer solutions built on Bitcoin, similar to second layer solutions built on gold, I think. And, the interesting security question then for Bitcoin is whether it can resist being centralized like gold was in central banks. Some implications for Bitcoin I discuss in the book. One that I find extremely important is the issue of time preference. I think a problem of easy money is that it loses value, and so it makes the future less certain for people. And because it makes the future less certain, it makes it more likely, it raises the cost of providing for the future, and therefore it makes it less likely for people to save for the future. And that reflects on all manner of decisions and outlooks on life, which gives people more of a present focused orientation rather than a future focused orientation. I think we see the same, we see the opposite happen under hard money. So if you compare, you think of the 19th century to today, people used to save much more in the 19th century. And if you look at what has happened as Western economies went off the gold standard, you see that saving rates continue to decline. The one country that continues to have higher saving rates was the last country to go off the gold standard, and that is Switzerland. So I think there's something there that suggests if we do move to a Bitcoin standard, effectively the world would have far less debt and far more saving, is the way that I would see it, if you move to a hard asset. Don't have much time to explain this in detail, but if you're familiar with the Austrian school theory of the business cycle, from that perspective, effectively easy money and the ability of governments to manipulate and central banks to extend credit unbacked by real savings, effectively manipulating interest rate downward and increasing the money supply, that is effectively the cause of the business cycle and inflation and recession. So, and for me, this is my favorite chart to illustrate this. Again, look at Switzerland. Up until the 1970s, when they were on the gold standard, they basically had no unemployment. There were no recessions. There was no unemployment. And then that started happening as they went off gold and started having a more conventional 20th century monetary policy. One other important application in my mind is that it will end the, having Bitcoin could offer us the way out of the Tower of Babel, that is the foreign exchange market, which is trading something roughly in the size of 25 multiples of GDP in terms of volume. All of it essentially because we've unsolved the problem of money in the 20th century by going off gold, which was one universal international apolitical money, and going to many different political monies, which effectively created a system of international barter, partial barter around the world. So in conclusion, I think Bitcoin, if I were to summarize what Bitcoin is, I would say Bitcoin is a technological and an apolitical solution to two problems. The first is international value transfer, and the second is saving or transferring value into the future. Bitcoin offers us essentially a technological solution for those things. It makes those things, the use of them, similar to using a computer. You're able to store your value in a computer in a way that is much more reliable and predictable and auditable than the traditional solutions that we have. And I think the intriguing possibility of Bitcoin is that it offers us the prospect of a real free market in money, savings, capital, and investments. That is all for the presentation. Thank you very much.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Multi-Advisor Hedge Fund Portfolios Series G and the SkyBridge G2 Fund, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.